The most common trading mistakes that are made by 90% of traders. Trading is 90% psychology and 10% execution. The lack of a trading plan is one of the first mistakes that traders make, for without a clear strategy, it will lead to impulsive decisions based on emotions rather than logic. And you ended up looking on the market and thinking, no, I should probably sell here, when really and truly that's just a retest for a buy. Or you should buy here when that's just a retest for a sell continuation. So knowing where you are in the market is very important. Having a well-defined plan is very important. Your entry and exit strategies, as well as your risk management rules. Number 2 is overtrading. Now, these are leveraged items that we are trading for the most part, some CFDs, some Forex, whatever the case being. If you try to capitalize on every single moment, leading to a lot of different trades, it will increase your transaction costs and expose you to unnecessary risk. And this happens very often. In fact, I am guilty of this myself in certain times. If I accidentally hold on to a bad trade, I tend to try and overtrade in order to compensate for that trade rather than just get the hell out of it. That has happened to me many a times. It's very important to choose quality trades rather than quantity, because you can make more from a good swing trade than you can from scalping. And this is what most people don't tell you, because when you trade on a 1 minute time frame, the chances of loss are more significant, which will also lead to more frequent trades and overtrading on smaller time frames. So it's often best to use the larger time frame to gauge where the market is, what it's doing, and then use the smaller time frames for your entry, and then refer back to the longer time frame for your take profit or your exit and your stop losses. Number 3 is failure to actually use the stop losses. Not using a stop loss can and will lead to significant losses if trades move against the trader. It's a very common mistake amongst beginners who are overly confident in their positions. You think to yourself, this is guaranteed to go down, it definitely will go down, and it keeps going up. Every time it comes down, it's just retesting to continue upward. And that has happened many a time. Every time it comes down, you get hopeful that it will come and break your price. But every time it comes close to your price, which is where you should exit and re-enter for a different position, you end up holding on to the trade, and then the trade reverses and goes against you even more significantly. Which leads to the next mistake, which is emotional trading. Allowing the emotions like fear, greed, and overconfidence will lead to trading decisions that have very poor outcomes. It will also lead to overtrading, as mentioned before. This emotional type of trading will result in chasing losses or holding on to losses for too long, and therefore running the risk of blowing your account. It's very important to maintain emotional discipline. Deep breaths, meditation, different techniques can be used to calm the mind. But the most important thing is to stick to your trading plan. Have your trading plan, write down your rules, and stick to your rules. Do not go against your rules. When you enter a trade, enter your stop and allow it to play out. If it hits your stop, it hits your stop. You plan for another trade. Simple as that. It's also important to keep a journal of your trades or a track record in order for you to analyze what it is that you have done. Next point is risk management. For a lot of beginner traders, ignore this. And as a result of ignoring risk management, you end up risking too much on a single trade or fail to diversify. You have to take different positions into account, because Wall Street costs a lot more to get into than the Nasdaq, Likewise, S&P is cheaper than both. So depending on how much money that you're working with, it might be better to trade the lower cost items, because Wall Street is a very tricky beast. Now, the next mistake that most traders make is chasing the market. Now, chasing trades after missing the ideal entry point will lead to poor trade execution and increase your risk. This happens when traders are afraid of missing out, which is the fear of missing out, the FOMO. Once again, it's important not to be afraid of the market. It's important to be calm mentally, psychologically. And this is very hard for most people because, we're only human. We have bills to pay, we have worries on our mind, and we have our reptilian brain that keeps on telling us that we shouldn't experience any type of pain. Unfortunately, in trading, you have to experience this pain in order for a trade to actually manifest itself. So, you have to rewire your mind, as most people say. The reptilian part of your mind, which is often associated with survival, will lead to the fear of missing out on a trade, and as a result, poor execution of your trade and losing positions. It's very important to be patient and wait for your proper moves. Set your limit entries if it does break out at a certain point, and wait for your right setup, because if you chase the market, the market can continue against you much longer than your liquidity can hold up. That's a lesson I learned from Tom Hugard, who is my trading mentor. There are no other YouTube traders that I consider my mentor other than Tom Hugard because of the way that he trades. I respect the man, I respect the gentleman, and I use him as an example to aspire to be like. So the next mistake that most people make is not being informed. Now you have to keep track of the economic data that's taking place, and as well as the indices that you're trading, what's associated with it. The fundamental data is just as important, even though most people tend to ignore it, but it does help. Fundamentally, some people trade straight on fundamentals, some people trade straight on technicals. I am the type that trades mostly on technical analysis, but at the same time, I do pay attention to the economics because it does affect what I am trading. The next mistake most people make is over leveraging. Now, this is a tricky beast because using too much leverage can amplify your gains and losses, which leads to significant risk. It's a common pitfall, especially in Forex. Now, over-leveraging is a double-edged sword because it can lead to significant gains if the trade goes in your favor. But if it goes against you, it can lead to even more significant losses. I personally would not encourage anybody to trade with more than 10% of their margin, but at the same time, if you really want to make money and you have a certain amount of money in your account, why are you trading with only 10% of it if you want to make money? So it's always a risk to reward that you have to keep in mind, and it depends on how you want to trade and the type of money you want to make. So all of this goes into your trading plan, and you should have your trading plan down. Most brokers don't offer more than 50% leverage or 50 to 1 leverage. There are some brokers that offer 100 to 1 or 200 to 1, and I personally like working with the high leverage items because it stands to make significant gains much faster. Yes, your losses can be much faster as well, but the gains are just as fast. So having your stops in place is the best strategy for high leveraged items such as CFDs, which is what I do trade. Now, the next mistake that most traders make is a failure to adapt. The markets are quite dynamic, and as you know, there's an ebb and flow, and the markets change. What worked in the past may not work in the future, and some traders basically fail to adapt their strategies that the market conditions are taking place in. The market may make a switch, and then people still stick to the same strategies that don't seem to be working anymore when the conditions change. You have to be a little bit more flexible in your trading strategy, and reviewing and adjusting your approach from time to time will help. There are some people like Tom Hugard who does not use any type of indicators or oscillators in his trading. He trades the naked chart, and I commend him for this, but that is something I do not do myself. I have my indications, I have my own style, I have my own plan, and sticking to it has been the biggest difficulty for me personally, because I'm only human and I do have the reptilian brain that I am trying to deactivate. The next mistake that most traders make, and this is number 10, is neglecting to review. You have to review what you have done in the past in order to learn from the mistakes that you have made. Keeping a proper journal, or basically a folder with all of your previous trades so that you can review what you have done, will help you to improve in the future. It provides insight into what works and what doesn't work, both your winners and your losers. So, keeping a journal and regularly reviewing it will improve your trading over time. And that's the bottom line. And there you have it, ladies and gentlemen. These are the 10 most common trading mistakes. If you like the content, do leave a like, comment, and subscribe. If not, I thank you for watching the video this far. Bless up yourself. And I wish you all the best in your trading journey.